There's been a lot going on in the world, and understandably, traders are looking for ways to make sense of all of this volatility. On the 2nd of April 2025, US President Donald Trump announced this comprehensive tariff package. S&P 500 kind of plummeted over 10%. In the next 3 days, the VIX has a negative correlation with US equities, and that means that when the VIX rises, the S&P 500 tends to fall. Revisit your trading plan and understanding whether your original trade thesis has sort of shifted with this sudden event. Some traders may manage risk, potentially reduce position size, diversifying exposure to safe haven assets, or even using guaranteed stop losses. Volatility can be tough, but if you got the right mindset and tools, you are already ahead of the game. Hi everyone, welcome to a special episode of Check the Charts with IG. I'm Jun Rong, Market Strategist at IG Singapore. Today's episode is a little different, where I'll go through some of the most relevant trading questions people have been asking lately. There's been a lot going on in the world, and understandably, traders are looking for ways to make sense of all of this volatility. So without further ado, let's dive into the first question. Well, geopolitical events may sometimes come as a shock. It may also catch many traders by surprise. At the onset, there will be a lack of details, and that will lead to this frantic scramble for information or clarity among traders. As such, the uncertainty may trigger trades based on emotion, such as panic selling or even self-doubts on trade positions. Just to give you an example, on the 2nd of April 2025, which we all know as the Liberation Day, US President Donald Trump announced this comprehensive tariff package, imposing a 10% baseline tariff on all imports and additional country-specific tariff, which was later delayed for 90 days. I think the chain reaction at that time was quite clear. The S&P 500 kind of plummeted over 10% in the next 3 days, and that marks its worst week since the 2020 COVID-19 recession, and even briefly dipping into bear market territory. At that time, the VIX also surged to its highest level since August 2024. On the other hand, we saw gold prices initially dip, but were actually quick to reclaim new record highs within the next few days as traders turned to gold as this hedge against portfolio volatility. Safe haven currencies such as the Swiss franc, the Japanese yen gained traction as well. And in terms of sector performance, defensive sectors held up much better than cyclical ones during the period of extreme fears. But of course, we should note that once the uncertainty clears, the rebound is also much more significant for the cyclical sectors. Well, there's no clear checklist of warning signs, but for example, if you look at the recent US trade tariff, I think those signs may sort of vary from shift in diplomatic languages. For example, from cooperation intent to maybe one of more confrontational. From the Russia-Ukraine war in 2022, Russia's troop build-up near Ukraine in late 2021 and early months of 2022 had also caused oil and gas prices to spike well before the actual invasion. In terms of cross-asset movement, generally we know that the VIX has a negative correlation with US equities. And what that means is that when the VIX rises, the S&P 500 tends to fall and vice versa. A rising VIX ahead of key geopolitical events can reflect market anxiety, which may or may not show up in price action just yet. So generally, when the VIX trades in tandem with the S&P 500 in the short term, what this means is that there are some market optimism, but also with some underlying anxiety. In that way, traders may be buying equities, but simultaneously hedging through options, which will suggest less conviction in the rally itself. In the case of currencies, movement tends to reflect capital flows driven by maybe risk appetite or even a perceived stability or confidence around the country. For example, in the case of risk appetite, we know there are safe haven currencies such as the US dollar, the Swiss franc, the Japanese yen. Those will often strengthen during geopolitical uncertainty. Whereas on the other hand, emerging market currencies tends to weaken due to risk aversion or potential capital outflows. But of course, in the case of US tariff uncertainty this year, we are also seeing some loss of confidence in US assets with the ongoing structural shift in trade dynamics. And that sort of outweigh the safe haven status for the US dollar, which lead to its broader weakness. For equities, stocks generally decline during heightened political tension, especially if the impact on the region involved is economically significant. For example, during the Ukraine-Russia war, the proximity of the Eurozone to the invasion has really significantly increased uncertainties for the region, and that at that time accounts for their lagging performance versus their US counterparts. Lastly, in terms of commodities, oil and gas tends to rise during tensions in the Middle East, and that is due to fears of supply disruptions. Gold, as we know, typically gains as a safe haven asset. In terms of wheat and other soft commodities, those can surge if conflicts may disrupt those major agricultural exporters, such as in the case of Ukraine, where trade routes and supplies were disrupted due to the Russian invasion. Well, I think the key here is to revisit your trading plan and really understanding whether your original trade thesis has shifted with this sudden event, be it in terms of the technical levels, the risk management rules, or whether the underlying fundamental reasons for your trade has changed. So going back to your original trade thesis will make sure that you are not making decisions in the heat of the moment where emotions may trigger you to act irrationally sometimes. A scenario may be around the recent US tariff where headlines around trade escalations, as we expected, tends to spark immediate risk-off reactions. And at that time, we have seen key support trend lines being broken down, moving averages gave way. The index also formed a new lower low. So at that time, it may be sort of best to pare down or long exposure, given the potential indications of a near-term shift in the trend. But thereafter, when volatility spikes above the 50 level, various sentiments indicators point to extreme fear, then at that time, one may consider jumping back for a near-term swing to the upside on extreme bearish sentiments. Yeah, there are various indicators out there, and they will give you an idea of where market sentiments are and hopefully allow you to identify some of the capitulation points in the markets. Probably a more well-known indicator, as we all know, may be the VIX, where usually a sharp spike in the VIX, especially above the 50 level, often signals fear-driven or emotional selling. I mean, we have seen this through historical instances. We have seen it back in 2008, 2015, 2018, and 2020, or even more recently in August 2024 or April 2025, where at that time market lows are formed when the VIX surged above that T50 level. Other indicators to gauge market sentiments may be the put-call ratio, the Fear and Greed Index, and the AII Investor Sentiment Survey. Of course, you can also use volume or market breadth as confirmation of a trend, or use intermarket divergences to justify whether market moves are in sync and are more sustained.
At IG, we've designed a CFD platform that puts you in control. Fast, intuitive, and tailored to your trading needs. Whether it's Forex, indices, or commodities, IG offers CFDs that let you trade on price movements without owning the underlying assets. Opening a CFD account is quick and easy. Ready to start trading smarter? Visit IG.com today and experience CFD trading with a trusted world leader.
Yeah, some traders may manage risk during unpredictable markets by focusing on capital preservation and strict risk control. And what this means is that they may potentially reduce position size, diversifying exposure to safe haven assets to reduce portfolio volatility, or even using clearly defined stop-loss strategies. Some traders may use guaranteed stop losses on equity index trades to sort of stay in the market without risking outsized losses. In that way, this will allow them to maintain exposure while protecting themselves against any unpredictable surprises, which in a way help them to strike this balance between staying opportunistic and staying safe. In volatile market conditions, I think traders should really approach leverage with extra caution. I think it's important to understand that leverage can amplify gains, but it can also amplify losses just as fast. I think the key during volatility market conditions may be to dial it down. And essentially, high volatility increases the likelihood of sharp price swings and stop-outs. So using lower leverage helps you stay in the game in the event of sudden drawdown if the volatility were to go against you. I think a more systematic approach may be to adjust your position size relative to the volatility of the asset you are trading. For example, if the ATR, otherwise known as the average true range or implied volatility were to spike, you can trade smaller size or reduce the number of open positions. It's also wise to set hard stop losses and avoid revenge trading to make back losses with aggressive leverage. I think different traders may have different opinions on this, but I believe volatile markets require the humility to prioritize capital preservation over the pursuit of maximized returns. When there's an open trade and a news event were to hit, I think the first thing to do may be to refer back to your original trade thesis, whether the news genuinely changed the underlying fundamentals or is it just noise, or in terms of the technicals, has certain predefined levels actually been breached. If the news were to invalidate the setup, then it will be advisable to really stick to your trading plan and exit quickly, even if it means taking a loss. I personally think it's dangerous to shift the goalpost in real time. And what I mean by that is that you abandon the initial trading thesis and you reformulate another new thesis just so to support your open position and really riding on hopes that the trade will eventually work in your favor. In terms of platform features, I think it's important to rely on preset stop losses and sometimes use guaranteed stops if I know an event could cause a gap. For example, like an interest rate decision, corporate results releases, or key economic data releases, such as the US non-farm payrolls or the US CPI. That way, you can remove emotional decision-making during peak volatility. And ahead of key volatility events, it may also be important to scale down exposure or position size so as to mitigate the risk of any unexpected surprises. Keeping fear from taking over during intense headlines can come down to having a clear trading process, predefined risk limits, and that boils down to your technical levels, and also the discipline to really stick to them, no matter what the headline says. Before entering any trade, I think it's important to define how much you are willing to risk, where the stop loss goes, and what will invalidate your trade overall. In that way, when markets were to get noisy, you are not scrambling to decide in real time. You will have already made the hard decision and the key levels in a calm state of mind previously. It's also important to remind yourself that not every headline warrants a reaction on your part. Many headlines may just be noise rather than signal. So in that way, taking breaks, limiting exposure during uncertain periods, using tools like guaranteed stop losses, all of these can help create a buffer between emotion and execution. At the end of the day, the goal is to have consistency, right? So having a clear, well-defined trading plan is always the key here. Well, when markets move fast and volatility surges, I think having the right tools in place will make all the difference. And I think that's where IG features really stand out. I think one of the most powerful risk management tools is the guaranteed stop loss orders, which ensures your position is closed at your preset level, even if the markets gets through it on any unexpected macro surprises. I think that kind of certainty will help remove all of those emotional decision making when prices are moving really quickly And that will give you confidence also that your losses are capped, no matter how wild things may get. Another essential feature, I believe, is a price alert. This helps you stay informed without being glued to the screen all the time. You can set alerts on key technical levels and get notified the moments those levels were to be hit. I think it gives you space to think and react strategically rather than impulsively. And together, these features can help you stay calm, focused, and in control, especially when those times where headlines are flying over and markets are all over the edge. Alright, that wraps up this episode. We have covered a lot, from how markets react to global headlines to how traders can stay calm and in control during all of the chaos. Volatility can be tough, but if you got the right mindset and tools, you are already ahead of the game. So if you enjoyed this episode, do remember to hit subscribe so you don't miss future episodes. And if you are looking to trade more confidently, check out the tools and support available at ig.com/sg.